You know what's interesting? Your smartphone has roughly 30 milligrams of gold inside it. Your car's airbag sensor? Gold. The satellites orbiting Earth right now? Gold. But most people still think of gold as something you lock away in a locker. Hello everyone. Welcome to Let's Talk Commodities, the YES Securities podcast where we decode the world's most important assets. Clearly, simply, and honestly. I am Rahul Saini, and today, we are talking about the one asset that has historically shown resilience across empire, market crash, and held its grounds through some of the worst financial crises in history. Gold. Not the jewelry version of that conversation, the investment version. Because here's the thing. Most people wear gold. However, very few people actually understand the importance of gold. So let's fix that. Because at YES Securities, we believe informed investing is the only kind that makes sense. That's why we say, invest karo, apne style se. Gold's story starts way back. The earliest gold artifacts ever found, discovered in what is now Bulgaria, date back to around 4600 BCE. Ancient Egypt was mining gold systematically by 3000 BCE. The Sumerians in Mesopotamia were crafting gold ornaments as far back as 2600 BCE. And here's the thing that blows my mind every time I think about it. Every civilization, every continent, every era, most of them independently arrived at the same conclusion that gold was worth holding on to. The Egyptians called it the flesh of the gods. The ancient Mesopotamian kings were buried with it. Indian royalty adorned themselves in it. And today, central banks are hoarding it. 6,000 years, one conclusion: gold matters. Here's a number that puts everything in perspective. As of end 2024, the World Gold Council estimates that approximately 219,890 tons of gold have been mined throughout all of human history. And since gold is virtually indestructible, it doesn't rust, doesn't decay, doesn't disappear. Almost all of it still exists today. Put it all together in one cube? That cube would just be 22 meters on each side. Smaller than most buildings. That's all the gold humanity has ever pulled out of Earth. And that scarcity, the physical geological scarcity, is fundamental to understanding why gold holds value. Today, the top gold producing countries are China at roughly 380.2 tons per year, Russia at around 330 tons, and Australia at approximately 284 tons. But here's the catch. New high-grade deposits are becoming rarer. Mining costs are rising every year. Ore grades are declining. And at current production rates of around 3,600 tons a year, the known economically recoverable reserves, roughly 54,770 to 64,000 tons, depending on the methodology, could sustain production for only about 18 to 20 more years. New gold isn't easy, and that matters. So why are we talking about gold now, in 2026? Because the numbers are extraordinary. Gold touched a new all-time high of $5,589 per ounce in January 2026. It set 53 new all-time price records in 2025 alone. In dollar terms, gold returned roughly 67% in 2025. That's not luck. That's a structural story playing out in real time. And right now, that story has a very specific backdrop. The conflict in West Asia, which had happened earlier this year, disrupted the Strait of Hormuz, through which 20% of the world's oil once flowed, sending Brent crude surging nearly 50% since February. For Indian investors specifically, a weaker rupee driven by our surging oil import bill means domestic gold prices rise even faster than global prices, making gold both more expensive to buy and more valuable to hold at the same time. This is also a good moment to introduce the gold to oil ratio. How many barrels of oil 1 ounce of gold can buy? With Brent oil at $105 and the Hormuz crisis, driving safe haven demand for gold, the ratio sits well above its historical range of 10 to 30. And when it gets this stretched, any diplomatic resolution could trigger a sharp correction, even if the long-term case for gold stays intact. Gold plays three very specific roles in today's financial system, and understanding all three is key. First, it's a safe haven. When markets panic, when geopolitical tension rises, when a currency starts to wobble, investors instinctively move to gold. It has relatively less counterparty risk. Second, it's an inflation hedge. When your rupee or your dollar buys less than it used to, and we've all seen what inflation can do, gold has historically helped preserve real value over the long term. Not perfectly every single year, but structurally, over time, it does its job. Third, it's a portfolio diversifier. Gold tends to move differently from equities and bonds, especially during market stress. Add it to a portfolio and it can help smooth portfolio volatility. But if you want one data point, just one, that tells you how serious the world has become about gold right now, global central banks bought more than 1,000 tons of gold in 2022, 2023, and 2024. 3 consecutive years above 1,000 tons. That hasn't happened since the 1950s. The 2010 to 2021 annual average was around 473 tons. Today's pace is more than double that. These aren't retail investors making emotional decisions. These are sovereign reserve managers in Poland, China, India, making 10-year strategic calls about what holds value. When they collectively double their rate of gold buying over a decade, that's a signal worth paying attention to. Now let's come home. Because India's relationship with gold is like no other country on earth. India consumed 802.8 tons of gold in 2024, making us the world's second largest gold consumer, right behind China. We account for nearly 26% of global gold demand as of June 2025 on a 4-quarter trailing basis. But here's the twist. India produces almost none of its own gold. The entire country's primary gold output, almost entirely from the Hutti gold mines in Karnataka, was approximately 1.5 to 2 tons in financial year 2024. That's it. So, we consume over 800 tons, we mine around 2 tons. That gap, nearly 500 times, is one of the most extraordinary mismatches between supply and demand anywhere in the world. What fills the gap? Imports. India imported approximately 812.22 tons of gold in 2024, valued at billions of dollars. Gold is consistently India's second largest import bill, right after crude oil. And yet, we never stop buying. Why? Because in India, gold isn't just an asset. It never has been. It's the jewellery at your sister's wedding. It's the coins your parents give at Dhanteras. It's the heirloom your grandmother passes down. Not just as wealth, but as love, security, and identity. Bridal jewelry alone drives for nearly half of all gold jewelry demand every single year. Gold in India sits at the intersection of emotion and economics. And that's a combination very few assets have come close to replicating. But that intersection is now at the center of a national debate. In May 2026, Honorable Prime Minister Narendra Modi appealed to citizens to avoid buying gold for a year, calling it economic patriotism. Because between oil and gold, India's import bill was bleeding the country's foreign exchange reserves dry. The industry's answer has been gold exchange programs, where old jewelry is traded for new designs without adding $1 to the import bill. Over half gold sales now come through exchange, but rural India hasn't shifted. Physical gold remains collateral, emergency savings, and a household anchor where financial products haven't yet reached. But here's what's changing, and this is the more exciting part of the story. The way India buys gold is evolving. In 2024, gold investment demand in India through bars, coins, ETFs, and digital gold hit 239.4 tons, up 29% year on year, and the highest level since 2013. The value of that investment surged 61% to 1,53,700 crores. Over the past 5 years, gold ETF holdings in India have grown from 21 tons to 63 tons. India is slowly, steadily shifting from buying gold because that's what we do to buying gold because it's a smart portfolio strategy. That shift is real and it's only going to accelerate. All right, let's talk about where and how you can actually get it. Globally, gold is priced through the London Bullion Market Association, the LBMA, which sets the internationally recognized benchmark price through a twice daily electronic auction at 10:30 a.m. and 3 p.m. London time. Gold futures also trade on COMEX in the United States, which is a part of the CME group. In India, gold futures trade on the Multi-Commodity Exchange, MCX, where retail and institutional investors can take exposure to gold price movements. But for most individual investors, the four main routes are physical gold, jewellery, coins, bars, the most familiar form, high emotional value, but comes with making charges, storage costs, and purity questions. Not always the most efficient investment vehicle. Gold ETFs, traded on stock exchanges just like shares, backed by physical gold, fully transparent and liquid. A great option for most investors. Sovereign gold bonds, issued by the RBI on behalf of the Government of India. These give you gold price exposure plus a fixed 2.5% annual interest rate. And if held to maturity, capital gains are exempt from tax. Gold mutual funds, invest in gold ETFs and are accessible even without a demat account. Great for SIP-based gold investing. EGR, and there's now a fifth option. NSE's brand new electronic gold receipts, or EGRs. Real gold in your demat account. One price nationwide and you can take physical delivery anytime. The barrier today isn't access, it's choosing the right form for your goals and being clear about why you're investing. Now let's be completely honest. Gold had a phenomenal 2024 and an even more phenomenal 2025. But that does not mean it's a straight line up from here. Gold is cyclical. Always has been. When global growth is strong, when equity markets are roaring, when interest rates are high and the dollar is firm, gold can underperform. Sometimes significantly. It doesn't generate cash flow. It doesn't pay dividends. It won't compound like a great business. Its return is entirely price appreciation. And that can be lumpy and unpredictable in the short term. The key drivers of gold prices? US interest rates. Higher rates make gold comparatively less attractive. Dollar strength. Gold is priced in dollars, so a stronger dollar typically pressures prices. And then the bigger macro forces: inflation expectations, geopolitical risk, and central bank demand. There are supply-side realities too. From discovery to production, the average lead time for a new gold mine is close to 17 to 18 years. That's not a typo. Almost 2 decades. And new major discoveries are increasingly rare. That structural supply tightness supports price over the long run. But in the short term, a shift in the US rate expectations, a stronger dollar, or easing geopolitical tension can trigger sharp corrections. We've seen it happen. So what does this mean for you as an investor? Most portfolio managers and research houses suggest a 5 to 10% allocation to gold as a way to meaningfully reduce overall portfolio volatility without giving up too much upside. And the form matters. Financial gold, ETFs, that is exchange traded fund, SGBs, that is sovereign gold bond, is almost always more cost efficient than physical gold when you factor in storage, insurance, and transaction costs. The principle is simple. Gold should stabilize your portfolio, not dominate it. It's insurance. And the best thing about good insurance is that you're glad you have it when you actually need it. Gold may not build roads, it may not power cities, and it certainly won't build the next great company. But it does something that quietly, consistently, across empires and centuries, nothing else has been able to replicate. It protects. Total global gold demand hit a record of 4,974 tons in 2024. The highest annual total ever recorded. And in 2025, demand topped 5,000 tons, even higher. This isn't a relic. Clearly, for a lot of investors and institutions around the world, gold still has a very real place in the conversation. For India specifically, the story only gets more interesting from here. Rising incomes, a growing investor class, deep cultural demand, and a fast evolving ecosystem of investment products. The shift from buying gold to understanding gold. And that's exactly the shift we want to help you make. At YES Securities, our approach is always the same: informed decisions, disciplined strategy, and a long-term perspective. Because the strongest assets aren't always the loudest ones. Sometimes they are the ones that quietly, steadily hold their ground across centuries. That's all for this episode of Let's Talk Commodities. Thank you for tuning in. We'll see you in the next one. Until then, invest karo apne style se.